Welcome students. In this video, we'll be looking at the accounting equation. When you look at a business organization, they have assets. These assets should either be introduced by the owner or they should buy it through an external person, through a loan. Let's look at this scenario in an illustration. The owner commenced the business introducing $10,000 in cash. So the business receives $10,000 cash, which is an asset. And then the owner's contribution will also increase by $10,000. Now, what do you call this owner's contribution in accounting? You call it the capital. So the organization has assets worth how much? 10,000. And what is the total of the capital? 10,000. Hence, the assets equals to the capital. Now, let's assume that the organization used this money to buy inventory of 2,000. So, when the organization spends money, the cash in the organization will decrease by 2,000. And the organization sells this inventory for $3,000, which means the cash of the organization will increase again by 3,000. So you are making a gain of how much? You are making a gain of 1,000 in cash. And what do you call this gain in accounting? You call it profits. Okay. At the end of the day, to whom does this profit belong to? The profit belongs to the owner. So the owner's contribution will increase by 1,000 because of this profit. Now what is the total assets of this business? It's 11,000. Then the total of the capital, that's again 11,000. Hence the assets equals to the capital. Now the business wants to buy a van. The value of this van is $30,000. And the business does not have the money. So the business goes and take this money from an external person through a lease. Now this lease is payable, which means the business has an obligation to pay to the leasing company, which means this is what? Now this is a liability for the organization. Clear? Now what is the total of your assets? The total of your assets would be 41,000. And the total of your capital is 11,000. And your liabilities 30,000. So when you add the capital and the liabilities, how much do you get? 41,000. What's the value of your assets? 41,000. So the basic accounting equation is derived. Okay, the basic accounting equation is assets equals to the capital plus liabilities. Okay. On screen now there is the first illustration. Now, using the knowledge that you gained from our previous explanation, try to do this on your own. Try to find the impact that each and every transaction would make on the three elements of the accounting equation. How would it increase or decrease your organization's assets, liabilities, and the capital? Now I'll let you to start working on it. Once you have completed, you can resume the video. Pause it now. I assume that you have completed your question. You have found the answers for all the 5 transactions. Let's see how well you have understood. The accounting equation that you're going to use is the basic accounting equation, which is assets equals capital plus liabilities. The first day is where ABO commenced the business introducing $1,000 in cash. So when AVO introduces $1,000 in cash, the cash is what? To what element does it belong? It's asset. So cash will increase by how much? 1,000. And then your owner's share will also increase by 1,000. So your capital will also increase by 1,000, which is your opening capital. Then when you look at day number 2, bought a motor car for 400 in cash. So you are using your cash to buy this motor car. So your cash is decreasing and you are receiving what? You are receiving a motor car. Now this motor car, to what element does it belong to? Now the motor car is a asset. So cash will decrease by 400 and another asset, motor car, will increase by 400. On day 3, you are obtaining a loan for $1,000. Now when you obtain a loan, what do you get? You get cash. So your cash will increase by 1,000. And what happens to your obligation towards external people? That will also increase. So your liabilities will increase by 1,000. So assets going to increase by 1,000, which is cash, and 1,000 liabilities, which is loans. On day 4, you purchase goods, 300 cash. Now this inventory, you will be using it in your business to generate future economic benefits. So this inventory belongs to what element then? It's a asset. Okay. So what happens is you create a new asset, which is your stock. So asset will increase by 300, which is your stock. Since you are paying cash, your cash will decrease by 300. Okay. Now on day 5, you sold goods on credit for 400. Okay. Now what do you mean by selling goods on credit? Are you receiving the money right now? No, you are receiving the money later. Okay. Now let's say you come to me and you buy something like, let's say you buy stationery, for a book for about 150. Okay. And you are saying that you're going to give it to me back. Now for me, you become an asset because on a future date, you have to pay me 150 rupees. Okay. You are a receivable for me. Okay. In business, we call these trade receivables. Trade receivables are also called as debtors. Okay. Now the trade receivables, they belong to what category? They belong to the assets category. So what happens is your assets will increase by 400, which is your trade receivables. They have to pay you 400 rupees. Now the value of the inventory that is sold is 300. So your inventory as an asset will decrease by 300. Okay. Now this 300 inventory was the expense or the cost of the goods that you sold. So now that becomes an expense for you. Right? You need to calculate the profit. So when you look at the capital cell here, under the capital column, right? You see that I have added the income of 400 and I have reduced the expense of 300. So your net effect is how much? 100, which is the owner's profits. Okay? Right. So this is how you record these transactions on the basic accounting equation. Now the basic accounting equation is again extended. Now this extension begins with the breakdown of capital. Now when you look at the organization's capital, you have the opening capital, which is the capital that is introduced by the owners. And then you have your additional capital, which is the capital that is introduced later on after the initial investment by the owner. Then when the organization makes a profit, the owner's share will increase. Now the owner will take a part of his share. Whenever he needs money, he will come and take a part of his share. So when the owner takes away a part of his share, we call it a drawing. So when there is a drawing, the owner's share will increase or decrease? The owner's share will decrease. Okay, therefore it will be shown as minus drawings in your accounting equation plus your liabilities. Then further on, you can look at profits and say profits equals to the income minus the expenses, right? So your accounting or equation is reorganized by breaking down profits. Now there are minus signs here, which is expenses and drawings. If I want to convert them into positives, what should I do? In mathematics, how do you do it? You take it to the other side of the equation. So I'm going to take the expenses and drawings to the other side and keep it along with assets. So your extended accounting equation will be assets plus expenses plus drawings will equal to the opening capital plus the additional capital plus the income plus the liabilities. Okay. So you can write this down in your tutorial. There is a space given to you under the accounting equation. So you can pause the video now, complete writing it, and then you can continue with the video. Now do the illustration number 1, which we did previously. Applying the extended accounting equation. Okay. Hurry up. Go do it. I assume that you have completed attempting the first illustration on the extended accounting equation. Now let's look at the answer. Now in this question you do not see drawings and you do not see additional capital. So I have removed those two elements from the accounting equation. The accounting equation we are going to use here is going to be assets plus expenses equals to the capital plus income plus liabilities. Now when you look at day number 1, 2, 3, 4, they are going to be exactly similar to the entries that we did under the basic accounting equation. I have explained this earlier, so I'm not going to look at it again. But the difference comes with the 5th transaction. Okay, the reason is previously profit was considered as a part of capital, but now you have taken out the income and expense, you have taken out profits away from capital, and you are considering it as two different elements. Okay, now let's look at this in general. So on day 5 you sold goods on credit for $400. Now when you sold goods on credit, you created trade receivables, so your assets is increasing by 400, which is your trade receivables, and your stock will also decrease by 300. Now this stock of 300 is the cost of that goods that you sold, so that is the expense of the sale, which means your expenses will increase by 300 as cost of sales. And then you are selling your inventory, so you have a sale. A sale is classified as what? It's classified as an income, so your income will increase by 400, which is your sales. Okay, so this is illustration number 1 in the extended accounting equation.